For 2 years, Wall Street had one question about Meta's AI spending. What if Mark Zuckerberg is simply building too much? But this week, that question changed. What if the overbuild is the business model? Meta has been one of the easiest AI stocks to criticize. The company prints cash from Facebook, Instagram, WhatsApp, and ads. Then it turns around and spends aggressively on GPUs, data centers, custom chips, and AI talent. To many investors, that looked like a familiar problem. A founder with control, a huge balance sheet, and a willingness to spend before the revenue is obvious. But the latest reports around a possible Meta compute business change the debate. This is not confirmed by Meta as a launched product. That matters. But the market reaction matters too, because investors suddenly saw a path where Meta's AI infrastructure is not only a cost center, it could become sellable capacity. The old bear case on Meta was simple. AI capex keeps rising, and nobody can prove the return. Data centers are not cheap. GPUs are not cheap. Power is not cheap. And unlike software, infrastructure does not scale with zero marginal cost. If Meta spends tens of billions building AI capacity and then cannot monetize it, shareholders are left with depreciation, energy bills, and a bigger fixed cost base. That is why investors have been so sensitive to every capex guide from big tech. They are not asking whether AI is important. They are asking whether the spending converts into cash flow fast enough. The reported Meta compute idea creates a different interpretation. If Meta has excess AI capacity, that capacity is not automatically wasted. It could be rented. It could support model access. It could become a cloud-style business aimed at developers and enterprises that need AI compute, but do not want to build their own infrastructure. In other words, the same thing investors feared as overbuild could become inventory. That is why the story hit more than just Meta. It also pressured names like CoreWeave and Nebius, because the customer buying compute can eventually become the competitor selling compute. Meta is not starting from zero. It already has one of the largest consumer networks in the world. It already has a massive advertising engine. And AI is already useful inside that engine, because better recommendations and better ad targeting can lift revenue without selling a new product to a new customer. That is the first layer of payback. Internal AI improves the core ad business. The possible second layer is external monetization, selling access to the infrastructure or models that Meta built for itself. That combination is what makes this more interesting than a generic AI cloud story. If Meta truly moves into AI compute rental, it does not only compete with small neo-cloud providers. It walks toward Amazon Web Services, Microsoft Azure, and Google Cloud. But Meta would not need to copy the entire cloud market on day one. The first wedge could be narrower: AI model access, GPU capacity, inference workloads, or tools around its own model ecosystem. That is important, because cloud markets are hard to enter, but specialized AI infrastructure markets are still being defined. The question is whether Meta can turn scale into trust. Enterprises do not just buy chips. They buy uptime, support, security, pricing transparency, and confidence that the platform will still matter 5 years from now. The bullish version is obvious. Meta turns a feared cost into a new revenue stream. The risk is just as important. Renting compute is not magic. If everyone builds too much AI capacity at the same time, prices can fall. If developers prefer AWS, Azure, or Google, Meta's capacity may stay internal. If Meta's models are not differentiated enough, model access may not command premium pricing. And if the company is only renting spare capacity, customers may worry about reliability and long-term commitment. A cloud business is not a press release. It is an operating system for enterprise trust. For investors, the key metric is no longer just capital expenditures. The key metric is utilization. A data center that sits idle is a liability. A data center that improves Meta's ad business is a productivity asset. A data center that can also be rented to outside customers becomes something else, a platform option. That is why this story matters even before Meta confirms a full product. It changes the question from why is Meta spending so much to how many ways can Meta make the same infrastructure earn money. This does not mean Meta is suddenly AWS. It does not mean the AI capex debate is over, and it definitely does not mean every dollar spent on AI will produce a high return. But it does mean the bear case has to get more precise. If the argument is simply Meta is spending too much, that may no longer be enough. The stronger argument has to prove that Meta cannot achieve high utilization, cannot create developer demand, and cannot turn AI infrastructure into either higher ad profits or external revenue. That is a harder argument than it was a week ago. So the next time you hear that Meta is overspending on AI, ask one question. Overspending compared to what? If the infrastructure only supports experiments, the bears are right. If it improves ads, powers Meta's own products, and eventually sells compute to outside customers, then Wall Street may have been looking at the bill and missing the asset. This is not investment advice. It is the framework. For Meta, the AI story is no longer just about spending. It is about utilization.